Hello, I'm David Frazier, the Chief Market Strategist and Senior Equity Analyst for our Insider Trader Alert Service. In this week's video and podcast, I'm going to briefly discuss two existing options positions that I want you to close out, as well as a new stock that I want you to buy, and a put option on that same stock that I want you to immediately write, that is sell to open, right after you buy the stock. So first of all, the two options that I want you to sell. I want you to sell the MGM, better look at my notes here to get the details correct. I want you to sell the MGM 2021 $35 call options, that is, close out your position on that call option, and I want you to close your position on the Kraft Heinz January 2020 27.50 put option. Now, by doing so, if you cover your position on the MGM January 21, 25, $35 call option, as of this moment, you'll capture approximately a 12.9% gain on that option. Now, obviously, that's not a big gain, especially for an options trade, but it's still a gain, and I like taking gains. In contrast, you'll make a huge return by closing out your Kraft Heinz January 2020 27.50 put option, the put option that we advised you previously to write on Kraft Heinz. And specifically, as of now, if you were to close out that position, you would generate a gain of approximately 841%. That's a big gain. So I want you to close out those two positions. Now, let's move on to the stock that I want you to buy. I want you to buy Zoom Video Communications. The symbol is ZM. I want you to buy that stock. It prices up to $72.50 per share. It's currently trading at around $68.50. So go ahead and be willing to pay up to $72.50 per share for the stock. And I want you to immediately write a put option on Zoom Video Communications. That is to write that put option to sell to open a put option on ZN immediately after purchasing the stock. And specifically, I want you to write a put option on the ZM January 2020 $60 put. And I want you to write that option at prices down to $2. It's currently trading at $2.40. Okay, I just wanted to get the details out of the way first. Okay, Zoom Video Communications. Who are they? What do they do? Well, the name kind of tells a lot about them. Zoom Video Communications makes video conferencing products. Now, obviously, there's numerous companies that make video conferencing products. But what makes Zoom Video Communications a little different than those other companies is it built its video conferencing products as a standalone cloud-based product and service. And that's different than other providers of video conferencing products. Other providers have really added on video capabilities to existing teleconferencing products. Zoom Video Communications cloud-based product and service can be accessed via your mobile phone, your laptop computer, or desktop computers. And this is a service where hundreds of people can join in and see each other and speak to each other online. So a great product. And what's great about it is what my IT people have told me. That is, IT professionals, not at Zoom Video Communications, but at different companies. 3 different people, one's at Oracle, and one's at Apple, and one's at Dell. And all 3 of these people told me that, in their opinion, Zoom Video Communications conferencing products are superior to other existing products. They said they're very, very easy to set up and use, and they just they're really good products. This is what these people have told me. I generally consult, when I can, people that have expertise in any given field when I'm researching any given company's stock, to learn as much as I can about the company and what they actually do and who their competitors are. Okay, well, that's special. How has the company performed? Well, the company has performed tremendously well. For example, during each of the past 2 years, that is during the year ended 2017 and 2018, the company's revenues rose by more than 118% during each of the 2 years, more than doubled the revenues. And even though the company lost $3.9 million during 2017, shortly after it began operations, it generated a $7.6 million profit during 2018. Well, it's continued to perform very, very well over the past 6 months. That is, specifically for the 6 months ended July 31st, 2019. The company operates on a fiscal year basis. So instead of its quarters ending in March, June, September, and December, the quarters end in April, July, October, and January. Well, during the first half of this year, that is from January to July of this year, its profits rose by 241% on a 99% increase in the company's revenues. So the company is growing at an extremely fast rate. And my research indicates that it's going to continue to grow its revenues and earnings at a fast pace for at least the next 18 months. Secondly, the company is extremely strong financially. Specifically, the company's cash and marketable securities alone cover all of its financial obligations, both short-term and long-term liabilities, by a ratio of 2.3 to 1 as of the quarter ended July 31st of this year. So that places the company in a position to withstand any temporary downturn in the economy, as well as to acquire other companies, to make strategic acquisitions. Now, here's what I really like about the company. Here I am throwing my notes all over the place. I don't like to ever chase after a stock. Even though the company's revenues and earnings grew at a very fast rate over the past couple of years and during the first half of this year, well, guess what? Its stock price, it didn't go public until April of this year. And from April to June of this year, its stock rose by 58%. Huge return. But it's too much risk there. Too many people chasing after the stock as it's moving up and up and up. What I like to see is the people start selling for no good fundamental reason, for the stock to go out of favor, to fall sharply when its fundamental operations, it's still performing very well as a company, but for its stock to fall apart, it goes out of favor and people start to ignore it. And that's exactly what happened from June of this year to October 22nd of this year. Its stock declined by 40% during that period. So there aren't a lot of people paying attention to it now. So what does that tell us? It's based on its fundamental revenues and earnings growth, it's trading at a bargain price. This is a good time to buy the stock. And that's when I like to buy a stock, when it's trading at a bargain price. So I want you to buy that stock at your earliest convenience. It prices up to $72.50. Now, right after purchasing the stock, as I mentioned earlier, I want you to write a put option on Zoom Video Communications. I want you to write a January 20 $60 put option. It prices down to $2. It's currently trading around $2.40. And why am I advising you to do that? Well, for two reasons. Well, for a few reasons, let's say. First of all, this is a small company stock. And small company stocks tend to be quite volatile, as has Zoom video communications. So, getting the timing right can often be difficult. So I think this is a good time to buy, but I hate for a stock that I buy or recommend for others to buy to all of a sudden be down 10 or 15% within a few days after we buy it. And that can often happen in these volatile stocks. So if you were to write a put option on it, well, you're going to reduce your cost basis in the stock. So that's the primary reason that I want you to write a put option on it. But secondly, let's assume for the moment that the stock were to decline to $60 a share and you were to get put the stock. That's great because you'll be buying more of the stock at a lower price. So I would welcome those shares. So that's, I think I'm going to wrap it up here. Next week, I'll talk a little bit about why I tend to advise buying and selling options with relatively short-term expiration dates for companies whose stocks tend to be very, very volatile. And I'll tell you more about that during next week's video, the reasons behind that. Thank you for listening and watching, and we'll speak with you again next week.